go back to our Christian roots and we go back to where we once were, it's America's best hope for revival.
So while the media is going to lie about you and label Christian nationalism, and they're probably going to call it domestic terrorism.
Well, yeah, it's been brought up a lot lately. So I guess I ought to explain it, since I like to explain stuff so gosh darn much.
My name is David Congdon. I'm an editor at the University Press of Kansas, but I'm also a theologian and scholar of religion and politics.
Oh yeah, David's gonna help me explain it too. We'll explain what it is, where it came from, and why so many gosh darn people keep talking about it lately. Did you know that your personal data is sold online by data brokers? Anyone can buy your personal detail. Hey, right, it's 2009/QR code. I'd scan you any day. Thanks to Delete Me for once again sponsoring this video.
Your food, your health, your life. Water fuels it all. Is your water the best it can be?
Is defined by Christianity. But I'll let David break it down even more. Go ahead, David. David.
I would define Christian nationalism as an ideology that fuses American political identity with Christian identity. There are two major versions of Christian nationalism. One group says that America was originally a Christian nation and it needs to be recovered. That identity as a Christian nation has to be restored. The other one says that America was never a Christian nation, and so it has to be reconstituted today to fulfill its true identity as a Christian nation.
Basically, some Christian nationalists believe the United States was founded as a Christian nation.
Folks, we were founded as a Christian nation. You can't erase that from our history. People try, but they can't do it.
Or that it should have a Christian form of government.
America should be a Christian nation.
And not just any form of Christianity, usually a very specific kind of fundamentalist Protestantism. Christian nationalism says American laws, institutions, and even identity should reflect Christian beliefs, often through government action.
Oklahoma State Superintendent Ryan Walters says schools need to go further. He has ordered all schools to incorporate the Bible and 10 Commandments into curriculum for grades 5 through 12. And now he says he's purchased 500 Bibles. The elected Republicans' ultimate goal? Put one in every Oklahoma classroom.
Yeah, that kind of stuff. I don't know how far back we want to go. Maybe we want to go all the way back, but the historical roots of Christian nationalism.
I would go pretty far back. I go back at least to the Reformation. So the Protestant Reformation in the 16th century, early 16th century, I think really set the path to Christian nationalism. Effectively what that did was it created a conflict between Catholics, Lutherans, and Calvinists. Mm-hmm. And they all began to fight with each other to see who was going to control the territory of the Holy Roman Empire. The principle was established later that century that whoever ruled a particular region, they got to pick the religion of that region. And we see effectively the origins of the nation state in that division of the empire up into these different units that are defined by a religious identity. And that's effectively where we see Christian nationalism in action. And a lot of today's Christian nationalists long for those days where you had a ruler who could say, we're Christian nation, you all are going to be Christian because I'm Christian. That sort of homogeneity of the country, of the nation.
It's not too far-fetched because you look at the Islamic world, there's plenty of theocracies.
Absolutely, and that's precisely what they would want on the Christian side in many ways.
The idea that the United States has a special relationship with Christianity goes way back. In fact, many of the early colonists came to North America to set up their own Christian society based on their own interpretation of the Bible, the holy book of Christianity.
The Puritan colonizers established theocracies. Those early colonies were theocracies in their view. Rhode Island is really unique in being one that was open to any religious belief. It was truly secular in that sense. But otherwise, there was a strong theocratic idea among those early colonies.
In colonial America, religion and government were like peanut butter and jelly. If jelly could, throw you in prison for not going to church. Most of the 13 American colonies had official Protestant Christian churches. In most of them, you had to pass a religious test and declare a religious faith, usually Protestant Christianity, of course, in order to hold public office or even vote. Here in Virginia, the Church of England was the established church. Even members of other Protestant denominations, like Baptists and Presbyterians, faced discrimination and persecution. But not everyone here in Virginia liked the idea of government and religion mixing. Famously, future Declaration of Independence writer and President Thomas Jefferson called for the separation of church and state and the establishment of religious freedom for all citizens. He'd create a bill, which eventually James Madison helped get passed in 1786, that did just that. It made the Church of England no longer the established church in Virginia and guaranteed religious freedom to all Virginians, even non-Christians like Muslims, Jews, and Hindus. That bill, called the Virginia Statute for Religious Freedom, was big time influential on the First Amendment. Flash forward to 1787. You remember 1787, don't you? Wait, you don't? You don't? That's when the Founding Father dudes got together to create a new constitution. In fact, the Constitution that so many Americans love and cherish today. Most of those men were, in fact, Christians. Some of those men were devout Christians who often quoted the Bible, but the most influential men there had absolutely no interest in making the United States a theocracy, or a type of government in which religious leaders ruled based on their religious beliefs and values. Benjamin Franklin strongly opposed using the government to prop up religion, as did George Washington, who once said, quote, "Every man ought to be protected in worshiping the deity according to the dictates of his own conscience." Heck, even James Madison, the freaking father of the Constitution, talked trash about the government favoring or establishing a single religion. Quote, "Who does not see that the same authority which can establish Christianity in exclusion of all other religions may establish with the same ease any particular sect of Christians in exclusion of all other sects?" And I couldn't find any evidence that any of the other Founding Father dudes tried to change their minds. Everyone at the Constitutional Convention was pretty much on the same page regarding mixing Christianity with the government. None of them tried to establish the United States as an explicitly Christian nation, bro. Like, not even a little bit. And if you look at the Constitution, it's an entirely secular document.
The Honorable Podium Series, engineered for exceptional results.
Secular just means not religious. Not once does it mention God, Jesus, or Christianity. And when it does bring up religion, it's like, bruh, leave religion out of this. Article 6, Clause 3 of the Constitution says, quote, "No religious test shall ever be required as a qualification to any office or public trust under the United States." And then later, for good measure, the Founding Father dudes added the beloved First Amendment, which says, quote, "Congress shall make no law respecting an establishment of religion or prohibiting the free exercise thereof." So basically, the Constitution says that the federal government can't create a national religion or interfere with religious practice. It's not actually in the Constitution explicitly that there's this wall of separation of church and state.
The wall of separation is an idea that, especially from Jefferson, Thomas Jefferson, who was a strong proponent of separating church and state.
And actually, I think he literally said that line too, right?
Yes, he did. Yes. John Adams, Thomas Jefferson, James Madison, they were very strong proponents of a society that was not based on any religious affiliation or identity, because they were all very concerned about the way Europe had created tests for blasphemy and heresy. For them, the wars of religion that I was talking about regarding in the Reformation era with the Catholics, the Lutherans, and Calvinists all fighting with each other, they thought that was the problem. Their vision of America was a society that didn't have those religious divisions and religious violence.
By the way, I was right. Jefferson did coin the phrase wall of separation between church and state with his letter to the Danbury Baptist Association. Okay, so the Constitution was a secular document, but that didn't mean the United States wasn't dominated by Christianity culturally. So, Christian nationalism again on the other side. In the early years of the country, where are we seeing that?
We're seeing that happen especially in the South, in particular, views there about Anglican and other Christian identities there connected to their Southern identity. Southern Presbyterians and others are very strongly Christian nationalists in a way that's more prominent than in the North, which leads into the Civil War divisions there.
The term Christian nationalism has only been around for about 20 years, but that didn't mean it didn't exist in the 1800s.
It's all the way through. Christian nationalism means different things in different times. It can be wedded to different political views at different points. It's anachronistic. Obviously, none of them called themselves Christian nationalists at that time. But in retrospect, we might see that there's a version of Christian nationalism there. There was a big move for about 100 years to create a Christian amendment to the Constitution. This lasted from the mid-19th century to the mid-20th century. And there was a campaign to add an amendment to the Constitution certifying that the United States is a Christian nation. And it failed, and it fizzled out by the time that Eisenhower became president. But that was a big movement for a long time.
You said it fizzled out when Eisenhower became president.
One of the first things Eisenhower does when he becomes president is get baptized. He is the first president to ever be baptized while in office. Yes.
Yeah.
So that's a big show of Christianity, of Christian nationalism, we might say now. But then that's what we see In God We Trust, the Pledge of Allegiance. We see the National Prayer Breakfast get started then as well. So a lot of these public displays of Christianity become prominent with the Eisenhower presidency. And at that point, there's a shift. It used to be that it was common knowledge that the Constitution was a godless secular document. At that point, the idea that the Constitution is actually a divinely ordained, truly Christian document becomes more widespread.
Yep, during the Second Red Scare, a period of hysteria and paranoia over the perceived threat of the Soviet Union and communism in general, the federal government began to more openly embrace Christian symbols as a way to counter the Soviet Union's attack on not just Christianity, but religion in general. In 1954, Congress added "Under God" to the Pledge of Allegiance. In 1956, it made "In God We Trust" the official national motto. It was basically just an easy way to contrast with the godless communists in the Soviet Union. Jump ahead to the 1970s, and a new movement began that mixed Christianity and politics, the moral majority. Led by folks like the influential Baptist minister Jerry Falwell, it played a pretty important role in mobilizing conservative Christians as a political force. This is when you got a big push to get Christian prayer back in public schools, for example. By the way, the Supreme Court had already ruled that prayer in public schools was already unconstitutional in the case Engel v. Vitale, which I made a video about. I think. That was a long time ago. Oh yeah. I'm pretty sure I did. Oh yeah, there it is. Hi! Cases like Abington School District v. Shemp and Lemon v. Kurtzman also further built up separation of church and state, and the moral majority was at least partially a reaction to those decisions. Your top 3 most influential Christian nationalists in American history.
This is tough, but my top 3, I think, in terms of influence, I go by influence more than by public knowledge. First one would be John Winthrop. So he's the person who preaches the City on a Hill sermon. He wasn't influential in his time, but he became influential in the 19th century when the City on a Hill sermon became circulated more widely as part of this campaign to spread this idea about America. It doesn't really happen until the 20th century, effectively. My second person may be unknown to a lot of people, but I think is maybe the most important. That is Robert Louis Dabney. Dabney was a Southern theologian and professor. He was a Confederate chaplain. He wrote many of the core ideas that became prominent later on with religious right. For instance, he had a piece against secular public education and in favor of homeschooling. Throughout his writings, he has this idea, this line, this is almost verbatim, but when something is non-Christian, it's actually anti-Christian. So Dabney's important. And the third person I'm going to pick, there's a lot of more recent figures. You can talk about Falwell or Rushdoony or others. I'm going to talk about C. Peter Wagner. Peter Wagner is not a household name, but what he did was he brought together the charismatic Pentecostal side of Christianity to be a force for Christian nationalism. His ideas and his teachings and his network eventually produced what we now call the New Apostolic Reformation. And that is a global network of millions and millions of people. It's maybe the largest faction of Christianity today, growing in size. And that's where we get a lot of these charismatic Pentecostal prosperity preachers and teachers, especially on YouTube and other influencers.
So today, what do Christian nationalists typically believe? If you already know the answer to this question, you should still watch anyway and see if I agree with you. Because you could be wrong.
Look,
Nothing.
nothing. Watch Miranda's story on Cabanuva.com.
Our air-dried power food is as nutritionally dense and digestible.
Gold prices hit a record high.
Up nearly 30% so far this year, torching stocks and bonds.
You could call it a modern-day gold rush.
This move higher in gold has been building for quite a long time.
Above $3,000 per ounce.
And arguably plenty more to go.
The look, the taste of it, the smell of it, that mixture.
So gold recently hit $3,300 an ounce, a new all-time high, and that really says things. To put things into perspective, 10 years ago, the gold spot price was hovering around $1,100. That's a 200% rise in a single decade. But what's even more remarkable is that in the past 3 years, gold has soared by nearly 90%, and this is during a time when stock markets were surging, interest rates were rising, and inflation was supposedly back under control. So what's going on? In this video, we're going to dive into why gold is so astronomically high right now, and more importantly, what that rise is really telling us. Because when gold moves this fast and this far, it's not just about investor demand. It's very often an economic warning sign. There are really 4 key points to talk about here, and I want to give a shout out to investing.com for helping me out with this video, particularly their Investing Pro subscription. I found this to be a really intuitive way to track my watch list, as it points to talk about as to why the price is so high at the current time. Now, the first and most common reason that people are bidding up the price of gold at the current time is because there is a lot of genuine fear out there around fiat debasement, or put more simply, the slow erosion of your money's value over time. Since the onset of COVID in 2020, the US dollar has now lost over 20% of its purchasing power. Now, that's not just a rounding error, that's 1/5 of your money quietly evaporated in just 5 years. You probably felt it too. Groceries cost more, rent jumped, interest rates spiked, but the money in your bank account doesn't stretch like it used to. After a long period of minimal inflation, over the past 5 years, inflation has roared, and it's eroded a lot of wealth that's been grounded in US dollars. Now, let's compare that to gold. Over that same period, the gold price has climbed by more than 100%, with a nearly 90% jump in just the last 3 years. So while cash lost value, gold gained value, and that's exactly why people like to turn to it in times like these. It's not necessarily about speculation, it's about preservation of wealth. Now, this idea isn't new. Gold has always been a hedge against inflation, but what makes this time different is just the scale of money creation we've seen post-COVID. Central banks have flooded the global economy with liquidity. This is the balance sheet of the Federal Reserve, and as you can see, trillions of dollars were printed and injected into the system in record time. And that's what's fueled a lot of the inflation we've seen. Sure, there were COVID supply shocks, but it's really the massive money printing that shook confidence in fiat currency. So naturally, during times like these, investors start looking for something outside that system, something with a limited supply, something that doesn't erode over time. And gold, with 5,000 odd years of trust behind it, fits that description perfectly. It may not earn cash flow as an investment, but in this context, it doesn't need to. Its job is to preserve value when paper money can't, and over the last few years, it's done that job exceptionally well. And that really leads us to the next reason why gold has skyrocketed, and this is a really big one. It is the growing concern around the US debt spiral. So right now, the US government is sitting on over $36 trillion in national debt, and that number is growing rapidly because of the ongoing deficit. So every second, the debt clock ticks higher. Every budget passed adds billions more, and this is really starting to concern investors. I mean, the US has lost its AAA rating from S&P and from Fitch, with both citing concern over America's ability to balance the books and repay their debts. And the problem isn't just the size of the debt, it's mainly the cost of carrying it. So thanks to higher interest rates, the interest payments alone on US debt are now over $1 trillion a year, which officially makes it one of the largest expenses in the federal budget. It's now bigger than defense spending. And just like a credit card that keeps growing, the longer that the US waits to properly address this, the more impossible it becomes to fix. But here's the kicker. How do you deal with debt like that? Well, governments really only have a few options. They raise taxes, which is unpopular and politically risky. They cut spending, again, not likely. We've seen Donald Trump do a 180 and agree on massive spending. And then there's the third option, the one that investors fear the most, which is inflating the debt away. It's kind of like looking back at someone who bought a house in the 1970s for, say, $25,000. Now, we hear that and think, whoa, housing used to be so affordable back then. I could have paid that off in a year. But it wasn't that cheap at the time. The average salary in the 1970s was around $8,700. That mortgage still would have felt very painful, similar to how it feels today. It only feels small now because inflation has done its thing. Today we sit here with, a $70,000 salary and the median house price is over $400,000. So when we look back, that debt seems like nothing. Now, governments think the same way. If they borrow trillions today and inflation drives up wages, prices, and tax revenues over time, then the real cost of that debt shrinks. They pay it back in devalued dollars. That's why gold investors are so nervous, because if inflation is the only realistic solution to this monster pile of debt, they don't want to be sitting in dollars that lose purchasing power. They want to be in something that holds its value no matter what the dollar does. So that's the second big reason why investors are flocking to gold and prices are so high at the current time. But then we get to the other reasons, external to the United States, as to why gold is going up so much at the current time. And this is really a big one in terms of the global economy. One of the core drivers of the gold price over the last few years has actually been other countries like China and Russia buying up massive amounts of the stuff as they look to reduce their dependence on US debt and the US dollar in general. For decades, US Treasury bonds were seen as the safest place to store wealth. If you're a central bank sitting on hundreds of billions in reserves, you just lent that money to the US government by buying treasuries and let the US government pay you a nice interest payment every year. That's just how it worked because it was perceived as such low risk. But that trust has started to erode. Why? Because countries like Russia and China have learned the hard way that the dollar isn't just a currency, it's also a geopolitical weapon. When Russia invaded Ukraine, the US and its allies froze hundreds of billions of dollars in Russian assets held overseas, most of it denominated in dollars. And that sent a message. If you end up on the wrong side of the West, your dollar-based wealth is not actually safe. And since then, we've seen a clear shift. Central banks around the world have started to reduce their reliance on US debt. Have a look at this chart. Look at the trend in Japanese and Chinese holdings of US treasuries over time. In 2020, China accounted for 15% of foreign holdings of US treasuries. But in December 2024, this percentage has shrunk to just 9%. They're clearly reducing exposure, as are other nations such as India and Brazil. And what are they replacing treasuries with? Well, gold, particularly in China, Russia, Turkey, and India. These countries have ramped up their gold purchases. In fact, over the past 3 years, central banks globally have added over 3,000 tons of gold to their reserves, some of the highest levels ever recorded. And as you can see by this chart from the Visual Capitalist, there are two main culprits. And this isn't just about sanctions either. China, for example, is dealing with deep cracks in its property market, an asset class that has traditionally been viewed as a safe haven for its wealthy citizens. As confidence in Chinese real estate falters, investors and institutions alike have turned to gold as a more reliable store of value. On top of that, both China and Russia are working to conduct more of their international trade outside the dollar system, sometimes even settling transactions in gold directly. So when you zoom out, the demand for gold isn't just coming from retail investors. It's being driven by entire nations rethinking what safe really means. And the more countries that move away from the dollar, the more demand shifts to something that has no allegiance, no politics, and no counterparty risk. And that something is gold. So when we look at the steep rise of the gold price over the last few years, that's what's really having the most effect. Massive buying by foreign nations to quite literally stuff their coffers with gold, as opposed to US government bonds. Now, in much the same vein, another major factor driving gold's surge is quite simply the rising geopolitical tension worldwide. You know, whether it's Russia's war with Ukraine, the ongoing conflict between Israel and Hamas, or growing concerns over a potential clash between China and Taiwan, the world feels a lot less stable than it did a few years ago. And in times like this, investors instinctively move towards assets that feel safe, and gold has always been one of them. It's like I just said, unlike stocks, currencies, or bonds, gold doesn't rely on governments, it doesn't rely on companies, it doesn't rely on peace to hold its value. It has no counterparty risk, no political allegiance, no CEO to mess something up. That's why whenever war breaks out or global tensions rise, we usually see a spike in the demand for gold. It's not because people think gold will go up, it's because they just want something real that they can trust if everything else starts to wobble. And right now, we're living through a moment where multiple regions are unstable at once, and the global order that underpins the financial system is starting to feel increasingly fragile. So they're the two geopolitical reasons behind the 2025 gold rush. And finally, the last piece of the puzzle is, of course, interest rates, and specifically the fact that they're now trending lower. So over the past couple of years, central banks around the world, especially the US Federal Reserve, have been raising rates to fight inflation. And for a while, that actually worked against gold. High interest rates meant investors could earn, decent returns holding cash or bonds, which made non-yielding assets like gold look less attractive. But now, the story is shifting. Inflation has cooled, the job market is weakening, and the Fed is signaling that rate cuts are on the table. And when interest rates fall, the opportunity cost of holding gold disappears. In fact, with real yields dropping, gold starts to look better than holding cash. Markets are already pricing in multiple rate cuts ahead, and gold is responding accordingly, because in a world where money is slowly getting cheaper again, investors want assets that can't be printed, can't be manipulated, and don't lose value when policy shifts, so gold fits that bill. And overall, they are the 5 forces working in gold's favor, which, because they're all happening at the same time, are kind of creating this perfect storm, causing the price to absolutely skyrocket. So overall, I hope you enjoyed the video. I do want to say a quick thanks again to investing.com for sponsoring this video. As a reminder, you can get 50% off in their sale at the moment, and then an additional 15% off using my code NEWMONEY at checkout. Also, a quick reminder for those wishing to come along to the 3-day live investing workshop in Atlanta with myself and Phil Town. We now have more people who have claimed a free ticket than what we have seats available, which means it's now a race. Basically, those who confirm their travel plans with the Rule 1 team will get those priority spots. So this is all sent in a follow-up email. So please, if you have not yet confirmed your flight or accommodation details with the Rule 1 team, please do so. That information should be in your inbox. I really don't want you guys to miss out, so please check that over. But with that said,
We ran a promotion cutting the price of Mint Unlimited in half, and it was so popular, we're doing it again.
Why airlines fly which plane where is mostly demand. Big planes fly to big places, small planes fly to small places. But it's not all demand. An incredible, nearly endless array of factors dictate the rest of it. While each airline is unique in how it decides which aircraft to fly, as an example, United Airlines has 28 different aircraft variants. This is quite inefficient. You can tell it's inefficient because low-cost airlines like Southwest and Ryanair streamline their fleet down to one aircraft type. Each additional aircraft variant in a fleet adds very real cost through increased operational complexity. Maintenance costs more, crewing is more complicated, even airport operations get less efficient. So each of United's 28 aircraft variants must somehow be justified. And perhaps the most convoluted justifications occur within the regionals, the very smallest aircraft in the airline's fleet. The composition of this subset is almost entirely dictated by Section 1C1 of United's fiercely negotiated collective bargaining agreement with the Airline Pilots Association, the union representing its pilots. This is what's referred to as the scope clause, and it essentially limits how much flying United can outsource to regional airlines. In the US, smaller aircraft are not technically operated by the major airlines whose name are on the aircraft, United, Delta, and American. Rather, they're operated on their behalf by regional airlines like SkyWest, Envoy, and PSA. The unions don't love this because it's pretty overtly a way to circumvent the higher pay rates they've negotiated. The pilots and cabin crew at the regionals are typically either non-union or represented by weaker unions, while United, Delta, and American consistently have more bargaining power than with their own staff since they can respond to cost increase.
At the beginning of July, the share price of a company called Opendoor sat at roughly 50 cents. On July 21st, the stock price peaked at almost $5, a gain of roughly tenfold. This massive rally happened despite the fact that the company did not announce any material news during this period. The rally was largely catalyzed by one man. Eric Jackson runs a hedge fund called EMJ Capital, which is presumably named after his initials. He is very active on Twitter, and over the past few weeks he has been incessantly posting about his long position in Opendoor. His tweets include AI-generated images of Donald Trump. He says he expects Opendoor's stock price will rise to $82. Jackson has accumulated a large following of retail investors who have followed his example and piled into the stock, thus resulting in a massive increase in trading volume and share price. Opendoor went public in 2020. It merged with a SPAC run by the infamous stock promoter Chamath Palihapitiya. Opendoor is a so-called iBuyer. They run an internet-based platform where they give instant cash offers to buy your house from you. They then try to flip the house, selling it to someone else for a higher price. The iBuying business model has been largely discredited. In 2021 and 2022, the real estate tech companies Zillow and Redfin shut down their iBuying operations after incurring large financial losses. Opendoor itself has incurred operating losses since inception. In 2024 alone, Opendoor incurred an operating loss of $320 million. Investors became increasingly skeptical of Opendoor's viability, causing a precipitous decline in the company's share price. The trading price of Opendoor's common stock declined by 95% until the recent rally catalyzed by Eric Jackson. In this video, we'll analyze Opendoor's operational performance, why Eric Jackson is bullish on the company, and how he created a meme rally.
If your credit is 700 or more, I can help you obtain upwards of $500K in funding to
Bullish on the company, and how he created a meme rally. Opendoor operates an online platform where they buy and sell homes. If you want to sell your home, you just type in your address and some basic information. They'll give you an offer almost immediately. The main selling point for homeowners is that they can get an offer and close the sale very quickly. Trying to sell your house with a traditional realtor can take weeks or even months. Opendoor charges a service fee of 5%, plus closing fees of approximately 2.5%. So the total fees they charge is slightly higher than the fees charged by a traditional realtor. In addition to the service fees, Opendoor also tries to sell each home for a higher price than they bought it. They call the difference between the buying and selling price the spread. To maximize the spread, Opendoor often gives lowball offers. For example, this Reddit user received a $725,000 initial offer from Opendoor for his home. Opendoor later revised the offer down to $658,000. He reached out to a local realtor who said the house should be listed for $750,000. He went with the realtor and ended up selling the house for $800,000. By using a realtor, this Reddit user received $142,000 more than Opendoor would pay him. In the most recent quarter, Opendoor sold 2,946 homes and generated $1.15 billion of revenue. So their average selling price was $391,400. Their cost of revenue was $357,800 per home. This includes the purchase price as well as any repairs or maintenance they had to do. So they made a gross profit of $33,600 per home. That sounds pretty good. But despite making such a large markup on each house sold, the company incurred an operating loss of $56 million and a net loss of $85 million in that quarter. So why is this the case? When Opendoor buys a house, they list it for sale, but it doesn't sell immediately. In the first quarter of 2025, they sold 2,946 homes, and they ended the quarter with 7,080 homes in inventory. Their inventory is 7 months worth of sales, which indicates that after they buy a house, it takes approximately 7 months to sell it. In the meantime, Opendoor is responsible to pay property taxes, HOA fees, yard maintenance, etc. Also, Opendoor borrows money to fund the purchase of the home in the first place. So while they're waiting for the home to sell, they accrue interest expense. So let's go back to the unit economics. They make a gross profit of $33,600 for each home they sell. They incurred direct selling costs of approximately $9,800 per home. This includes things like broker commissions, external title and escrow related fees, and transfer taxes. While Opendoor usually buys houses directly from homeowners, they sometimes buy them through third-party real estate agents. That's why there are broker commissions. Opendoor incurred holding costs of approximately $5,800 for each house. This is mostly property taxes and HOA fees. And finally, they incurred interest expense of $9,800 per house. This interest is only from the debt they borrowed specifically to purchase houses. Opendoor also has some corporate level debt, which isn't included here. After subtracting these expenses, Opendoor's profit per house declines to just $8,200, giving them a contribution margin of just 2%. As an aside, Opendoor reports its contribution profit before interest expense. So they claim their contribution profit is $18,000 per house. In my opinion, it's only fair to include the interest expense, because they need to borrow money to buy the houses, and the more houses they buy, the more they have to borrow. Traditional realtors tend to have strong connections in their local communities. They acquire new customers through word of mouth, attending community events, and things of that nature. As an online-only platform, Opendoor does not have these advantages. This obliges them to spend heavily on advertising. In the first quarter of 2025, Opendoor spent approximately $52 million on marketing. This equates to almost $18,000 for each house they sold. That's far in excess of the $8,200 contribution profit they made per house. Throughout 2021, Opendoor rapidly expanded. They were flush with cash from their recent SPAC merger, so they expanded into new markets and ran expansive marketing campaigns. Their revenue peaked in the first quarter of 2021 at more than $5 billion. However, they've been consistently unprofitable. In the orange bars, I have their operating profit minus property finance expense. On this metric, they've only been profitable in one quarter. In the first quarter of 2022, they eked out a profit of $60 million. The only reason they made a profit is because during the quarter, home prices across the US increased significantly. Remember that it takes a few months for Opendoor to sell each house. If home prices are rising in general, this benefits them. In the second half of 2022, home prices declined, and Opendoor reported a massive loss. Throughout 2023 and 2024, US home prices increased modestly. Despite this, Opendoor reported losses every quarter. In an attempt to decrease their losses, Opendoor has exited some markets and become far more selective in their home purchases. Back in 2022, they were selling more than 10,000 houses per quarter. This has now decreased to around 3,000. We've laid the foundation of why Opendoor has struggled over the past few years, and why their stock price declined 95%. Now let's listen to the bull case from Eric Jackson.
They have high revenue, but the market doesn't think they'll ever be profitable. This quarter, which they're going to report in a couple of weeks, they've already sort of hinted that it's going to be their first EBITDA positive quarter in something like 3 years. And so the thing is, like, can they get to steady state profitability? I think they can. And if they can, that's when investors are going to do the same thing they did with Carvana. And they're going to say,
I emphasize again, it is free to join my community. The stocks I share are also free.
Hey guys, just a quick
and they're going to say, well, I guess we were too bearish. I guess we got to recalibrate here. What's a good forward multiple to apply to this company? And I think, 5x is reasonable. If you go out to 29, it's there's supposed to be $12 billion of revenue that year. That's the Bloomberg, consensus number if you pull it up on the terminal. That's how you get to smack $82 a share if you kind of back out the debt and the cash and you look at the share count and all that kind of stuff.
Let's unpack what he said. Currently, Opendoor has a very low price-to-sales multiple. This is because the company is losing money. Jackson thinks the company will become profitable. Once the company becomes profitable, Jackson expects the price-to-sales multiple to increase to 5. He also expects Opendoor's revenue to more than double by 2029. This gets him to an $82 price target. Opendoor indeed provided guidance saying they expect to report adjusted EBITDA of between $10 and $20 million in the second quarter. Adjusted EBITDA excludes stock-based compensation, which is expected to be approximately $15 million. So they're guiding for their real EBITDA to be barely break-even. EBITDA does not take into account interest expense. They accrue roughly $30 million of interest expense per quarter from the money they borrowed to buy the houses in the first place. So even if they break even on EBITDA, they'll still report a net loss. Maybe we're just splitting hairs by looking at the interest expense instead of just the EBITDA. But there's a more fundamental problem with Jackson's bull case. He says Opendoor will reach steady state profitability in the second quarter. But even if they do report a profit in the second quarter, there's nothing steady about the current state. The only reason Opendoor's profitability is improving is because they're increasing their buy-sell spread. In other words, they're only making lowball offers. Obviously, if they only make lowball offers, less people are going to accept these offers. As a result, Opendoor only expects to purchase 1,700 homes in the second quarter. This is a massive decrease from the 3,600 homes they bought in the first quarter. This will result in a decrease in sales in the second half of the year because they won't have as many homes to sell. Eric Jackson is trying to have his cake and eat it too. He says the profitability will improve and the revenue will increase. But the only way to increase profitability is to make lowball offers, which will result in lower revenue down the line. Opendoor itself says this. Despite the poor quality of Jackson's analysis, he has garnered more than 60,000 followers on Twitter. He incessantly tweets memes about Opendoor, including an AI-generated picture of Donald Trump holding an Opendoor stock certificate. Many of Jackson's Twitter followers are retail investors who have piled into Opendoor stock. As of Tuesday, July 22nd, Opendoor was the single most mentioned stock on the investing forum StockTwits. The third most mentioned Twitter was a cryptocurrency called Based Chad. That gives you an idea of what type of people are active on StockTwits. So what is Eric Jackson's background, and why do so many retail investors follow his advice? Prior to 2016, he was a stock market commentator. He wrote articles for financial publications including The Street and Forbes, where he would talk about stocks. In 2016, an unknown billionaire noticed his articles and liked what he read. So he contacted Jackson, offering to give him some money to start a fund. That's how Jackson started his hedge fund, which he named EMJ Capital. So what is Eric Jackson's background, and why do so many retail investors follow his advice? Prior to 2016, he was a stock market commentator. He wrote articles for financial publications including The Street and Forbes, where he would talk about stocks. In 2016, an unknown billionaire noticed his articles and liked what he read. So he contacted Jackson, offering to give him some money to start a fund. That's how Jackson started his hedge fund, which he named EMJ Capital. He mostly invested in speculative growth stocks, following a similar investment strategy to Cathie Wood. Up until 2021, his performance was stellar. One of his long positions was the online used car retailer Carvana. Let's listen to a short clip of Jackson talking about Carvana in May of 2022.
I think the most controversial name on your list and what has become one of the most in the market itself is Carvana. Why Carvana now?
Everyone loves to hate Carvana. This stock is amazing. It went down 75% from last summer till the end of 2021. And then it's gone down another 75% this year. Everyone hates it. They think they can't make money. That, you know, a lot of people are as bearish on it as they were bearish on Tesla, saying it's going to go bankrupt. The fact is, though, similar to Amazon back in the day, they've invested in a huge infrastructure for their used cars. They can, through that platform, they're going to sell more used cars in the future when they figure this out. They're going to sell new cars. They're going to sell fleet management. They will be around.
2022 was a bad year for Carvana. By January of 2023, its share price fell to as low as $4. The company was losing huge amounts of money and was burdened with a massive debt load. At the time, we actually posted a video about Carvana. We speculated that the company may soon face bankruptcy. 2022 was a disastrous year for Eric Jackson. It wasn't just Carvana. Most of his portfolio was concentrated in speculative money-losing companies. These were the stocks that got hit the hardest during the 2022 bear market. It got so bad that his billionaire benefactor lost confidence and pulled out all of his money. As a result, EMJ Capital lost 99.5% of its assets under management overnight. Against all odds, Carvana secured emergency funding and its business started to recover. Over the following 2.5 years, Carvana's stock price surged almost 100-fold from its lows. Jackson maintained his Carvana position, so benefited from this rally. However, he was starting from a very small base. He says EMJ Capital still only manages a few $1 million, despite his massive Carvana gains. On Twitter, Eric Jackson describes himself as the Carvana hedge fund guy. All he does is try to find the next Carvana. Now he's saying Opendoor is the next Carvana.
For most businesses, hiring can take a long time. Not for Susan, though. She uses ZipRecruiter to find quality candidates fast.
Now he's saying Opendoor is the next Carvana. On the surface, Opendoor does seem to share a lot of similarities with Carvana. Carvana buys and sells used cars from consumers. They buy used cars for a cheaper price and sell them for a higher price. Both companies fund their operations with large amounts of debt. However, there are also a few key differences. Carvana gives lowball offers just like Opendoor. Maybe your used car is worth $10,000 and Carvana gives you a $9,000 offer. You might be willing to make this sacrifice for the convenience of getting an instant quote online and not needing to haggle over the price. Used car salesmen are notoriously sleazy and won't hesitate to rip you off. If you understand the value of your car and are good at negotiating, you might be able to get a better price than Carvana. But it's also possible that you end up getting an even worse deal. The home selling process is very different. You hire a realtor who works for you. Your realtor is incentivized to get you the best possible price because their commission is a percentage of the sale price. It is true that you have to pay a large commission to the realtor, but the fees charged by Opendoor are even higher. For most people, their home is their most valuable asset by far. If you have a mortgage, the value of your home may even be greater than your net worth. When selling your house, you have hundreds of thousands of dollars on the line. It is well known that Opendoor gives lowball offers that are typically tens of thousands of dollars below market value. Very few people are so impatient that they are willing to sacrifice so much money just to save a few weeks or months. Because of the poor value proposition, Opendoor is obliged to spend exorbitantly on marketing, and it still remains a very niche offering. Eric Jackson got lucky with Carvana. This has given him credibility among many retail investors. By saying Opendoor is the next Carvana, he was able to catalyze a meme rally. But this does not change any of the fundamental problems faced by the company. I do not expect this to end well for Eric Jackson or his followers. Alright guys, that wraps it up for this video. What do you think about Opendoor? This video is brought to you by Meeting.ai, a powerful AI transcription tool which was instrumental in my research for this video, but more on them later. Robinhood was founded in 2013 as an online stock brokerage offering zero commission fees. This was a revolutionary concept at the time, as the legacy brokerages charged as much as $10 per trade. Robinhood became a huge success as young investors with only small amounts of money could finally afford to participate in the stock market. The old school brokerages started losing market share to Robinhood. In 2019, they too were obliged to remove commission fees, and zero commission trading became industry standard in the US. Robinhood went public in 2021. The company's revenue, profits, and stock price have skyrocketed over the past 2 years, and its market capitalization has surpassed $80 billion. Robinhood's success can largely be attributed to the many new product offerings they've rolled out over the years. On June 30th, 2025, they announced what was perhaps their most interesting innovation to date. Using blockchain tokenization, Robinhood now allows retail investors to buy fractional shares of private companies, including big names like OpenAI and SpaceX. This move was quickly condemned by OpenAI itself. They said Robinhood's OpenAI tokens are not OpenAI equity. They did not partner with Robinhood. So if these OpenAI tokens are not equity, what are they? In this video, we'll look at the meteoric rise of Robinhood over the past few years. Then we'll analyze the details of the blockchain tokenization product they recently announced. Online stock brokerages including Robinhood experienced explosive growth during the pandemic. With people stuck at home and flush with cash from government stimulus, it was a perfect time for novice investors to enter the stock market. In the second quarter of 2020, Robinhood had 9.8 million funded accounts. By the middle of 2021, this had more than doubled to more than 22 million. Since then, their number of users has stagnated, only increasing to 25.8 million by the first quarter of 2025. Despite user growth stagnating, the value of customer assets has surged over the past 2 years. At the end of 2022, total customer assets were worth $62 billion. By the first quarter of 2025, this had more than tripled to $221 billion. There are a couple of reasons for the large increase in customer assets. Firstly, US stocks experienced a strong bull market, so stocks held by Robinhood customers have increased in value. Secondly, Robinhood has experienced strong net inflows of new deposits from existing customers. With its sleek user interface, the Robinhood app is attractive to the tech-savvy younger generations. Young investors may start off depositing a very small amount of money into their Robinhood accounts. As they advance in their careers and see their incomes rise, they'll deposit larger sums over time.
Critics are raving about Marvel Studios' The Fantastic Four.
Really?
Yeah. Oh yeah! And now it's certified crap.
Incomes rise, they'll deposit larger sums over time. Over the years, Robinhood has also increased the product offerings on its app, aiming to cover all the needs and desires of the average retail investor. In the beginning, Robinhood only supported trading of stocks and ETFs listed on major US exchanges. They have since expanded into options, crypto, and even real-world betting markets. This feature was added shortly prior to the 2024 US presidential election. Robinhood users can buy futures contracts that pay out if a certain event occurs, such as if Donald Trump or Kamala Harris wins the election. Robinhood makes its money through payment for order flow. Instead of directly executing customer orders on the stock exchange, the orders are routed to market-making firms. There are many firms that specialize in profiting off the order flow from retail investors, the most famous being Citadel Securities. For any given stock listed on the exchange, there is an order book. This shows at which prices market participants are willing to buy or sell the stock. Let's look at the example of Apple's stock. The highest bid is $208.79. This means if you want to sell a share of Apple stock, someone is willing to buy it from you for this price. The lowest ask is $208.83. If you want to buy a share of Apple, this is the lowest price at which someone is willing to sell it to you. Apple is a very liquid stock, with a lot of people actively trading it at any given time. So the spread between the highest bid and the lowest ask is very small. In this case, it's 4 cents, or about 0.02%. When a Robinhood user wants to sell a share of Apple stock, Citadel will buy it from them for $208.79. Then, when another Robinhood user wants to buy Apple stock, Citadel will sell to them for 4 cents higher. So they make a tiny profit on each trade. This is a very profitable activity for Citadel. Then, in this case, it's 4 cents, or about 0.02%. When a Robinhood user wants to sell a share of Apple stock, Citadel will buy it from them for $208.79. Then, when another Robinhood user wants to buy Apple stock, Citadel will sell to them for 4 cents higher. So they make a tiny profit on each trade. This is a very profitable activity for Citadel, so they're willing to pay Robinhood for the order flow. Stock options have significantly less trading volume than stocks. This typically results in a much larger bid-ask spread. For example, the highest bid on this Apple call option is $3.35, and the lowest ask is $3.40. That's a spread of 5 cents, or 1.5%. Remember that the bid-ask spread on Apple stock itself was only 0.02%. Thus, market makers like Citadel can make a much greater profit per trade on options compared to stocks. In the stock market, the SEC enforces something called the Order Protection Rule. This requires brokers to route customer orders to a trading venue, displaying the best available price. If you put in a buy order for a given stock, Citadel is not allowed to sell that stock to you for a price higher than the lowest asking price across the entire market. Thus, Citadel's margin for profit is constrained. The Order Protection Rule does not apply to cryptocurrency transactions. Crypto brokerages like Robinhood are allowed to route your crypto orders to market makers, even if they offer a worse execution price compared to other market makers. Unconstrained by regulations, crypto market makers can make far more profit per trade. They are thus willing to pay Robinhood far more for the order flow. In the first quarter of 2025, Robinhood processed $413 billion worth of stock trades and $46 billion worth of crypto trades. So the crypto volume is only about 11% of stock volume. Yet in that same quarter, Robinhood generated $252 million of crypto transaction revenue and only $56 million of stock transaction revenue. So crypto, while representing 11% of the volume of stocks, generates more than 4 times as much revenue. Robinhood also generated $240 million of revenue from options trading. Robinhood does not disclose the dollar value of its options volume, but it's safe to assume that it's a tiny fraction of the stock trading volume, as only a small minority of investors trade options. While Robinhood is technically commission-free, the profits generated by the market makers ultimately comes from retail investors. This is manifested in the form of slightly worse prices every time you make a trade. If you trade stocks, especially if you only trade shares in large liquid companies, the cost is so small as to almost be immaterial. The small percentage of Robinhood users who actively trade options in crypto are responsible for the vast majority of the company's revenue.
The fantastic 4-in-1 pizza, only $7.99 at Little Caesars.
Okay, pizza.
Percentage of Robinhood users who actively trade options in crypto are responsible for the vast majority of the company's revenue. Transaction revenue is only one part of Robinhood's total revenue. They also make significant amounts of net interest revenue and other revenue. In the most recent quarter, Robinhood generated $927 million of total revenue, of which 63% was transaction-based, 31% was net interest revenue, and 6% was other revenue. The other revenue segment mostly consists of the Robinhood Gold subscription service. Being a Gold member costs $5 per month. You receive a number of benefits, including interest paid on your idle cash through their so-called Cash Sweep program. In the Cash Sweep program, the idle cash in your brokerage account is deposited into a high-yield savings account at one of Robinhood's partner banks. Currently, Robinhood makes approximately 5% from their partner banks. They keep about 1% for themselves and pay 4% to Robinhood Gold members. If you are not a Gold member, your idle cash will be invested into short-term treasury bills, and Robinhood does not give you any of the interest. Gold members also receive other benefits, including larger instant deposits and access to the Robinhood Gold credit card. In early 2024, Robinhood launched its own credit card called the Gold Card. To get this credit card, you need to be subscribed to Robinhood Gold. The Robinhood Gold Card has a number of benefits, including 3% cash back paid on all purchases. This is a very high rate of cash back. The generous cash back rate is a loss leader to convince people to order the card. People who carry a balance on their credit card from month to month pay an interest rate of 22 to 30% based on their credit score. If you always pay your credit card bill in full at the end of each month, you of course don't pay any interest. The 3% cash back you receive is subsidized by the people who fail to pay off their balance and accrue massive interest expense. Robinhood's balance of interest-bearing assets has increased substantially over the past couple of years, rising from about $15 billion in 2022 to more than $45 billion today. The majority of this increase comes from the Cash Sweep program for Robinhood Gold users. As interest rates have risen, many Robinhood users are opting to hold more idle cash in their accounts to take advantage of the Cash Sweep offering. Despite the generous 3% cash back, the Robinhood Gold Card has failed to see much traction. As of the end of the first quarter of 2025, they only have $429 million of credit card loans outstanding, representing less than 1% of their interest-earning assets. Robinhood has benefited tremendously from the Federal Reserve's interest rate hikes over the past 3 years. In the first quarter of 2022, they generated $55 million of net interest income. In the first quarter of 2025, they generated $290 million. They have more interest-bearing assets, and they make a higher yield on those assets. Thanks to strong growth in trading volume and net interest income, Robinhood's revenue has more than tripled over the past 3 years. While they used to incur operating losses, they are now massively profitable. In the first quarter of 2025, they generated an operating profit of $370 million, representing an operating margin of 40%. Recently, Robinhood announced what was perhaps its most ambitious product launch to date. On June 30th, 2025, they hosted an event called To Catch a Token. The company did everything possible to hype up the event, with CEO Vlad Tenev even filming a cinematic trailer for it. They rented a super luxury villa in the south of France to host the event, with a large Robinhood logo placed in the middle of the pool. The event was published on Robinhood's YouTube channel. The video is 44 minutes long, and most of it is frankly really boring. When doing research for videos like this one, I frequently have to watch through long videos or transcripts, just to get a few important pieces of information. I recently started using a tool called Meeting.ai, which is also the sponsor of today's video. I listened to customers who signed up for the app during the event. On the left here, we can see the various topics of the presentation separated in OpenAI. Meeting.ai also provides timestamps, mentioned below, where viewers of this channel can receive a special discount.
For OpenAI. And not just OpenAI, but also SpaceX. SpaceX is in here too. If you download the Robinhood EU app, which we gave you ample warning to do, you're about to figure out why we gave you that warning. I'd like to transfer these tokens to you and give you exposure to two of the most valuable private companies in the world right now.
Currently, Robinhood's tokenization offering is only available in the EU due to the bloc's relatively lenient financial regulations. Robinhood launched in the European Union in December of 2023, but at first, their EU app only supported crypto trading. Now it supports stock tokens, a blockchain-based system to indirectly invest in US-listed stocks. So how does this work? Say you want to buy an Apple stock token. You pay money to Robinhood. Robinhood will go to the NASDAQ and purchase one share of Apple. Robinhood retains ownership of this Apple share. Robinhood gives you an Apple token, which is essentially a futures contract designed to track the price of Apple's stock. The token is created on the Arbitrum blockchain. This is effectively a decentralized database to keep track of who owns the token. If you want to exit your Apple position, you sell your token back to Robinhood. Robinhood will sell the Apple stock on the NASDAQ and send the proceeds of the sale to you. So what's the point of the stock token? Why not just transfer ownership of the stock to the investor in the traditional manner? Robinhood advertises a number of benefits of stock tokens. There are no commission fees, so you can buy fractional shares with just €1. Fractional shares and commission-free trading already exist without blockchain tokens. The only real benefit is 24-hour market access. You can trade your stock tokens outside of regular trading hours. Robinhood maintains proprietary pricing algorithms which they use to quote you a price even when the stock exchanges are closed. While this is certainly a benefit, the use of blockchain tokens hardly seems necessary. Instead of using the Arbitrum blockchain, Robinhood could just as easily maintain its own internal database to keep track of who owns the tokens. The original selling point of cryptocurrencies is that they are decentralized and therefore not controlled by any corruptible institution. But even though the tokens are recorded on the decentralized Arbitrum blockchain, the underlying stocks are still owned by Robinhood, which is a centralized institution. So there's really nothing decentralized about the process. The crypto community has long struggled to find real-world use cases for blockchain technology. Robinhood certainly tried to play into this as well. They even invited Ethereum co-founder Vitalik Buterin to speak at their To Catch a Token event. Robinhood CEO Vlad Tenev hyped up the stock tokens as the first real use case for crypto, but they have yet to create any capability that did not already exist.
Could you say no to this? Neither will your kids.
Travel can make you smell kind of funky, but aluminum-free Secret Whole Body deodorant gives me 72-hour whole body freshness. For long layovers, surprise gate changes, and heavy luggage. And it's totally middle seated.
Capability that did not already exist. Now let's talk about the stock tokens for private companies, specifically OpenAI and SpaceX. OpenAI and SpaceX have conducted numerous private funding rounds. Many venture capital firms and other private investors own shares in these companies, even though these shares are not traded on stock exchanges. Robinhood purchased a few $1 million worth of OpenAI and SpaceX stock. It's unclear if they participated in a funding round or purchased a stock from another investor in a private transaction. Robinhood ran a limited time promotion whereby EU customers received €5 worth of these tokens for free. The valuation is presumably based on whatever price Robinhood acquired the shares for. So a bunch of Robinhood's European customers have these tokens in their accounts, which are supposedly worth €5. But for the time being, they can't really do anything with them. You will only be able to sell your token if Robinhood makes this functionality available at some point in the future, which may or may not ever happen. If Robinhood ever sells its OpenAI or SpaceX stock, they'll distribute the proceeds to the token holders. OpenAI was quick to condemn these stock tokens, saying they do not represent real equity. If you own one of these tokens, you don't actually own any stock. The stock is legally owned by Robinhood, not you. Vlad would probably argue that the tokenization program is still in its infancy. Eventually, it will become more sophisticated, and there will be a liquid secondary market. This will democratize access to private market investments. But this is a horrible idea. When a venture capitalist invests in a private company, they conduct due diligence. They might meet with the founders and request the company's internal financial documents, which they must review to make an informed investment decision. A retail investor does not have these advantages. If you're given the opportunity to invest in SpaceX, for example, how are you supposed to know if it's a good investment? Private companies do not publish audited financial statements or give disclosures of any kind to the general public. We don't even know how much revenue SpaceX generates. There are sporadic media reports, but these are of questionable reliability. How can you be expected to make an intelligent investing decision when you have almost zero information? While giving away a few OpenAI and SpaceX tokens might make for a good publicity stunt, it makes absolutely no sense as an actual investment product. Alright guys, that wraps it up for this video. What do you think about Robinhood stock tokens? Let us know in the comments section below. The world of cryptocurrencies has experienced various hype cycles throughout its lifetime. The first hype cycle was in 2017 when the rise of the price of Bitcoin catalyzed the creation of thousands of new altcoins. Once it became clear that almost all of these altcoins were scams and Ponzi schemes, people became more skeptical of crypto in general. This resulted in a long bear market. The second big hype cycle started in 2020. Many amateur investors were flush with cash from government stimulus. The Fed's zero interest rate policies pushed investors towards more speculative investments, including cryptocurrencies. This is when institutional investors gradually started to take a serious interest in crypto. Most notably, the enterprise software company MicroStrategy started to buy Bitcoin. It eventually transitioned into a so-called Bitcoin treasury company. By the end of 2022, the crypto bubble had popped. As the Fed started raising interest rates, traditional investments became more attractive. Many investors started pulling their money out of crypto. Throughout 2022, a number of crypto companies were exposed as frauds, most notably the crypto exchange FTX. This greatly damaged sentiment, resulting in another bear market which would last throughout 2023. In 2024, the crypto industry donated hundreds of millions of dollars to the Trump campaign. If elected, Trump promised to be the most pro-crypto president in American history. When Trump won the presidential election, investor sentiment became frenzied, and the Bitcoin price surged to new all-time highs. Trump has made good on his promise by canceling enforcement actions against crypto companies, abolishing the Justice Department's Crypto Enforcement Division, and even launching his own official meme coin. The Republican-controlled Congress is fully on board with Trump's pro-crypto agenda. The week of July 14, 2025 has been dubbed Crypto Week by the House Financial Services Committee as they hope to pass a number of pro-crypto bills. With crypto now enjoying the full support of the government, this asset class has achieved a legitimacy on Wall Street which it has never enjoyed in the past. MicroStrategy, the original Bitcoin treasury company, now has a market capitalization of $125 billion. Today, at least 60 publicly traded companies have added Bitcoin to their balance sheets, hoping to gain the same share price premium that MicroStrategy's achieved. As the number of Bitcoin treasury companies increases, the market risks becoming oversaturated. This has led some companies to turn their attention to Ethereum, which is the world's second largest cryptocurrency after Bitcoin. In recent months, a number of penny stock companies have transitioned to Ethereum treasury companies, where their sole purpose is to accumulate Ethereum coins. Upon announcing this, they have seen their share prices surge. In this video, we'll analyze the speculative mania that has gripped the crypto market since Trump's election. We'll look at the new pro-crypto legislation Congress is on the verge of passing. Then we'll look at the recent phenomenon of Ethereum treasury companies, and why this whole bubble will probably not end well for investors. Under the previous administration, the main controversy centered around whether cryptocurrencies should be regulated as securities. Former SEC Chairman Gary Gensler argued that the vast majority of cryptocurrencies are securities and must be registered as such. Based on how the SEC's regulations are currently structured, it would be almost impossible for most cryptocurrencies to comply. In 2023, the SEC sued Coinbase and a number of other crypto exchanges, accusing them of selling unregistered securities. These lawsuits were very complex. They were still working their way through the courts by the time of the 2024 presidential election. Upon taking office, one of the first things Trump did was fire Gary Gensler and halt all these lawsuits. While the immediate threat to the crypto industry was averted, the legal status of cryptocurrencies was still uncertain. While Trump halted the SEC enforcement actions, there is nothing to stop a future administration from bringing them back. The Congress is currently considering the Digital Asset Market Clarity Act. This act would classify most of the well-known cryptocurrencies, including Ethereum and Solana, as commodities instead of securities. If this is codified into law, no future administration will be able to reverse this without another act of Congress. The second bill Congress is considering is the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or the GENIUS Act. This act creates a framework for the regulation of stablecoins. Under this law, banks and other financial institutions are allowed to issue and use stablecoins, as long as they are backed one-to-one with US dollars, which can only be invested into short-term treasury bills. The stablecoin market is already very large. One of the biggest stablecoins is USDC, which is issued by a company called Circle. Currently, there are 63 billion USDC stablecoins outstanding. For the most part, stablecoins are used by crypto traders. When they want to exit a crypto position, they'll exchange their crypto for USDC. This is faster and cheaper than selling them for real cash. Stablecoins are also used by criminal organizations for money laundering. To date, stablecoins have not seen significant use in the real economy, at least not the legal real economy.
I sent you money with the Remitly app so you can buy a new TV.
Remitly helps you be there even when you can't.
First form, protein bars and sticks. High protein, maximum taste. 20 grams of protein in every bar.
To date, stablecoins have not seen significant use in the real economy, at least not the legal real economy. Crypto bulls hope that the GENIUS Act will change this. The regulatory clarity around stablecoins may convince large banks and other traditional financial institutions to begin incorporating stablecoins into their business operations. JP Morgan CEO Jamie Dimon has long been a vocal skeptic of cryptocurrencies, but even his bank will now start experimenting with stablecoins. In a recent conference call, Dimon explained, quote, "We're going to get involved in stablecoins to understand it, to be good at it. I think they're real, but I don't know why you'd want to use a stablecoin as opposed to just a payment," unquote. The pro-crypto stance of the Trump administration and the expected passage of the Clarity and Genius Acts have created a lot of hype around the Ethereum cryptocurrency. This is for two main reasons. Firstly, many stablecoins are built on top of the Ethereum blockchain. Secondly, Ethereum's blockchain allows for so-called smart contracts, which are used in various decentralized finance or DeFi applications. The idea is that thanks to the regulatory certainty, more of these DeFi applications will be developed, thus increasing the usage of Ethereum. In recent months, a number of Ethereum treasury companies have been created. These companies intend to follow essentially the same strategy that Michael Saylor pioneered with MicroStrategy. But instead of holding Bitcoin, they will hold Ethereum. These companies have no real operations. Their only purpose is to issue shares and other dilutive securities to the public. They'll use these proceeds to acquire Ethereum tokens, which are referred to as ETH. Ethereum uses a proof-of-stake consensus mechanism, whereby ETH holders can stake their tokens, earning an annualized yield of approximately 3%. Three of the largest Ethereum treasury companies are BitMine Immersion Technologies, SharpLink Gaming, and Bit Digital. BitMine was previously a Bitcoin mining company. In June, they announced they would stop mining Bitcoin and instead become an Ethereum treasury company. They hired a man named Tom Lee to be their new chairman. Tom Lee frequently appears as a talking head on CNBC. SharpLink Gaming was previously a penny stock company engaged in the sports betting industry. They hired a man named Joe Lubin to be their new chairman. Joe Lubin is one of the co-founders of Ethereum. Bit Digital is similar to BitMine. They also used to be a Bitcoin mining company. They announced they'll stop mining Bitcoin and become an Ethereum treasury company. Remember that the entire purpose of Ethereum treasury companies is to issue dilutive securities and use the proceeds to purchase ETH tokens. For this to work, you need to have a high stock price. As the leader of an Ethereum treasury company, your main job is to get as much airtime as possible to promote your stock. Let's start off by watching a recent interview given by SharpLink chairman Joe Lubin on CNBC.
So Ethereum is scalable enough, affordable enough, legal enough in the United States. It's very usable right now, but we haven't had the applications and we haven't had the consumer end users and the enterprise end users because former Chair Gensler made it really unattractive to use tokens or issue tokens or build applications in our ecosystem. So that is all behind us. We still have a lot of ether out there and not enough activity to sop it up.
So let's try to unpack what this guy is saying. Now that Gary Gensler is gone, there will be an explosion of DeFi applications built on top of Ethereum, which will soak up the supply of ETH tokens, thus resulting in the ETH price increasing. To understand this, we need to understand the tokenomics of Ethereum. When a stablecoin issuer such as Circle creates a new stablecoin, they need to do this on top of a blockchain. They can use the Ethereum blockchain or many others. The Ethereum blockchain is essentially a decentralized database which can keep track of who owns each stablecoin. Once the stablecoin is issued, crypto traders will trade this stablecoin amongst each other. To trade a stablecoin, you need to update the ownership data on the Ethereum blockchain. This requires an Ethereum transaction. To execute an Ethereum transaction, you need to pay a transaction fee using the ETH token. This is called the gas fee. The gas fees are burned, meaning the ETH tokens are deleted. Such as Circle creates a new stablecoin. They need to do this on top of a blockchain. They can use the Ethereum blockchain or many others. The Ethereum blockchain is essentially a decentralized database which can keep track of who owns each stablecoin. Once the stablecoin is issued, crypto traders will trade this stablecoin amongst each other. To trade a stablecoin, you need to update the ownership data on the Ethereum blockchain. This requires an Ethereum transaction. Let's try to unpack what this guy is saying. Now that Gary Gensler is gone, there will be an explosion of DeFi applications built on top of Ethereum, which will soak up the supply of ETH tokens, thus resulting in the ETH price increasing. To understand this, we need to understand the tokenomics of Ethereum. When a stablecoin issuer such as Circle creates a new stablecoin, they need to do this on top of a blockchain. They can use the Ethereum blockchain or many others. The Ethereum blockchain is essentially a decentralized database which can keep track of who owns each stablecoin. Once the stablecoin is issued, crypto traders will trade this stablecoin amongst each other. To trade a stablecoin, you need to update the ownership data on the Ethereum blockchain. This requires an Ethereum transaction. To execute an Ethereum transaction, you need to pay a transaction fee using the ETH token. This is called the gas fee. The gas fees are burned, meaning the ETH tokens are deleted. This decreases the circulating supply of ETH tokens. Based on supply-demand dynamics, this is bullish for the ETH price. This is offset by new ETH tokens which are awarded to stakers. Remember that you can stake your ETH and make a 3% yield. The yield comes from newly minted ETH tokens, which is of course inflationary. Here we look at the example of stablecoins, but there can also be other decentralized applications that run on top of the Ethereum blockchain and likewise pay gas fees. Joe Lubin argues that there will be an increase in DeFi applications, which will increase the gas fees, thus increasing the trading price of the ETH token. Unfortunately, the data tells a different story. The gas fees charged per Ethereum transaction have declined dramatically over the past 5 years. This is despite the fact that stablecoins and DeFi protocols have increased substantially over this same period. So why is this the case? One of the main reasons is the advent of so-called Layer 2 blockchains. These are blockchains built on top of the Ethereum blockchain. Instead of transacting directly on the Ethereum blockchain, DeFi applications including stablecoins can execute their transactions on the Layer 2 blockchains. These Layer 2 blockchains aggregate a large number of transactions and execute them on the Ethereum blockchain at the same time. This results in a much smaller number of transactions on the Ethereum blockchain itself, and consequently much lower gas fees. The existence and growth of the Layer 2 blockchains is a big problem for the Ethereum tokenomics narrative. Recently, Sam Tabar, the chairman of Ethereum treasury company Bit Digital, appeared on a crypto-focused podcast called Unchained. The host asked him about this very issue.
What I'm saying is if Ethereum keeps, scaling the L2s, and as we know at the moment, the L2s, they don't they don't really pay Ethereum very much for hosting that activity. So how do you see value accruing to ETH?
For most businesses, hiring can take a long time. Not for Susan, though. She uses ZipRecruiter to find quality candidates fast. Spend less time hiring and more time building your business. Try for free at ZipRecruiter.
Very much for hosting that activity. So how do you see value accruing to ETH?
I see value accruing to it is all network effects. It's going to be all very indirect. I'm sure that obviously the ETH treasury strategies are going to directly increase value to ETH because we're buying hundreds and hundreds of millions of dollars of ETH. If you probably add all of us up, it's going to be definitely in the billions. So I just see all of this. I understand your question.
So it's not necessarily connected to the activity. It's just like speculation, or
it could be speculative, but no, it's all network effects. If these L2s are building and they're not directly contributing to the price of Ethereum, surely there is increased mind share that's happening of Ethereum based on those L2 projects. That creates awareness, that creates a virtuous cycle, that creates a mind share, and then you have retail buying Ethereum because they're beginning to understand the thesis. It's just about mind share. That's why Bitcoin is up where it is now. It had first mover advantage, so it has this large mind share.
Okay, yeah, I still don't feel like your answer addresses tokenomics. It's more like marketing or something, the way you're answering this.
It is. I'm answering it in the form of mind share. It is marketing in some ways, absolutely. And marketing is the only way you're going to really get a large section of retail to buy Ethereum. There are a lot of people who are speculating on Ethereum and Bitcoin. They don't quite understand the L2 project. So I'm trying to answer your question directly in terms of how Ethereum pricing is going to be affected by L2 projects. I understand not directly, but through mindshare and through marketing and through narrative that's being finally distributed, you're going to have retail understanding what Ethereum can do, because you can't have these kinds of L2 projects on Bitcoin. So you're going to find these retail buyers buying Ethereum instead of Bitcoin because of this mindshare. But there's no direct connection. I agree with you.
According to Sam Tabar, retail speculators are too dumb to understand the Layer 2 projects, so they'll just buy ETH tokens because they've heard of it. It's difficult to make a bull case for Ethereum based on actual tokenomics, so the narrative of the Ethereum promoters becomes bizarre and mystical. Let's go back to Joe Lubin. He recently appeared on a crypto-focused podcast called Bankless, where he tried to explain Ethereum's bull case.
I'm really loving the idea of framing Ether as framing trust as a commodity. If we think about how much value sprinkling some Ether dust or chunks of Ether or an Ether diamond, an Ether trust diamond, onto a transaction, onto a relationship, onto an agreement on the Ethereum blockchain, the kind of facilitation that brings, the kind of guaranteed execution that brings, what does that do to the value of each one of these transactions or processes? I think it's more than 10% increase in value. I think it's kind of hard to imagine. Is it 100%? Is it 1,000%? And so if you do that to the world GDP, what's the size? What's 100 times, 1,000 times the size of global GDP running on Ethereum rails?
So according to Joe Lubin, the Magical Ether Trust Diamond is worth 1,000 times the world's GDP. As of the time of recording this video, SharpLink's share price is $37. The company currently has 106 million shares outstanding, giving it a market capitalization of approximately $4 billion. They have 281,000 ETH tokens on their balance sheet, which is currently worth about $950 million. In other words, SharpLink has approximately $9 of ETH per share. If you invest in SharpLink stock, you're paying $37 for $9 worth of ETH. Why would anybody do this? Especially when there are open-ended Ethereum ETFs that trade at a price equal to net asset value. Let's hear Joe Lubin explain why his company is a good investment, despite its massive premium to net asset value.
We're seeing TradFi being onboarded to DeFi. Because these things are, so let's think of them, to use a silly phrase, as perpetual motion machines for a little while, where because there is more demand for Ether and Bitcoin, because we got more applications on this new kind of decentralized World Wide Web, there's a lot of people that believe price is going to go up. You're sitting with your shares and you're seeing the Ether concentration go up when more and more people invest in this company that you're invested in. And what do Wall Streeters care about? All they care about is making money. And so if they see this thing working for a while, if they hear people in earnings calls talk about the details of Ethereum, the details of DeFi, and this particular strategy, what are they going to do? They're going to become expert in our technology, just like we did, for different reasons.
Mr. Lubin describes his company as a perpetual motion machine. People think the stock price will go up, so they'll buy the stock, thus pushing up the price. As the price rises, more people will notice the stock, resulting in even more buying pressure. It's very interesting that he uses the term perpetual motion machine. A perpetual motion machine is a hypothetical machine that can work indefinitely without an external energy source. This kind of machine is impossible, since its existence would violate the first and second laws of thermodynamics. Machines that extract energy from finite sources cannot operate indefinitely because they are driven by the energy stored in the source, which will eventually be exhausted. In the case of SharpLink, the source of money is retail investors who buy the stock. Before SharpLink became an Ethereum treasury company, it had 660,000 common shares outstanding. Since late May, the company has been issuing new shares almost continuously to fund its ETH purchases. The share count has increased 160-fold to 106.5 million. These stock sales have yielded proceeds of approximately $750 million. Eventually, the retail investors will run out of money, and the perpetual motion machine will grind to a halt. Alright guys, that wraps it up for this video. What do you think about Ethereum treasury companies? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one.
Save time and money booking your all-inclusive vacation with a Budget Beach Finder, and you can be a little extra. With one click, the Budget Beach Finder compares vacation.
It's been a while since we've made a video about Lucid Motors, so it's high time we check back in on the company. With its first vehicle sales starting in 2021, Lucid makes luxury electric sedans and SUVs. The company has developed some impressive technology, and its EVs boast industry-leading performance specifications. But performance comes at a price, and their cheapest model starts at $70,000. Very few people can afford to purchase Lucid's cars. In 2024, they only delivered slightly over 10,000 units to customers. Their Arizona-based factory has a nameplate capacity of 90,000 cars per year. When a factory has low utilization, the fixed costs are absorbed by only a small number of units, leading to a very high cost per car. In the most recent quarter, Lucid's production costs were $149,000 per car. Their average selling price was only $76,000, resulting in a gross loss of $73,000 per car. And that's before you even consider corporate overhead. In 2024, Lucid incurred an operating loss of $3 billion with no obvious path to profitability. The only reason the company has lasted as long as it has is thanks to the support of their controlling shareholder, the Saudi Arabian Sovereign Wealth Fund. Saudi Arabia has invested $8 billion into Lucid and now owns 58% of the company's outstanding shares. Going into 2025, it looked like Lucid was little more than a money-losing vanity project of the Saudi government. On July 17th, Lucid announced a much-needed piece of good news. They signed a deal with Uber, who will purchase 20,000 Lucid SUVs for their upcoming robotaxi service. As part of the deal, Uber will make a $300 million equity investment into Lucid. This is a big deal for Lucid, not just because they received some much-needed funding. The fact that Uber is willing to put so much of their own capital at risk is a huge vote of confidence. In fact, this is the first strategic investment Lucid has received other than the Saudi Sovereign Wealth Fund. Lucid's stock price increased by 1/3 when the deal was announced. In this video, we'll analyze Lucid's recent performance. Then we'll look at their new robotaxi partnership with Uber, and whether this could turn around the company's otherwise bleak outlook. Lucid's first car was the Lucid Air sedan. It boasts high-performance specifications and a luxurious interior. The Air has generally received favorable reviews from customers and critics alike, but its high price point has greatly limited sales. When they first started deliveries in 2021, the cheapest trim was the Lucid Air Pure all-wheel drive, which started at $87,400. In an attempt to boost sales, they launched a cheaper rear-wheel drive version starting at $77,400. Sales volume was disappointing, so they were forced to cut prices again in 2024. Today, the Lucid Air Pure starts at $70,000. This makes it cheaper than the Tesla Model S, which is its main competitor. The price cuts have resulted in a lower average selling price realized by Lucid. At the beginning of 2021, their average selling price was $106,000. By the first quarter of 2025, this had declined to $76,000. As the company ramped up production, they have realized some manufacturing efficiencies. Back in 2023, they incurred gross losses of approximately $250,000 for each car they sold. By 2024, their loss per car declined to about $75,000. While this is a significant improvement, it's still an unsustainable rate of loss. In late 2024, Lucid launched an electric SUV called the Gravity. SUVs are the most popular vehicle segment in the United States, representing 58% of new car sales in 2024. Lucid sells some cars in Europe and Saudi Arabia, but the vast majority of their sales are in the US. Given the popularity of SUVs in the US, they hoped the Gravity would sell better than the Air. Lucid started selling the Gravity Grand Touring in late 2024, which has a starting price of $95,000. Towards the end of 2025, they plan to release a cheaper trim called the Touring, which will start at $80,000. Let's see how the Gravity Grand Touring stacks up against the competition. It is more expensive than other electric SUVs, such as the Tesla Model X and Rivian R1S. The Gravity has a range of 450 miles, which is extremely impressive for a full-size SUV. The only other electric SUV with a comparable range is a Cadillac Escalade IQ, which is even more expensive at $130,000. The Gravity can accelerate from 0 to 60 miles per hour in just 3.4 seconds. This level of performance is almost unheard of for a full-size SUV. With its long range, high performance, and luxurious interior, the $95,000 price tag of the Lucid Gravity is actually pretty good value for money. The problem is there aren't that many people who are willing and able to spend $95,000 on a car. After the launch of the Gravity, Lucid's deliveries jumped up by 3,100 vehicles per quarter. The rate of deliveries has more than doubled since 2023. Even still, Lucid's Arizona factory is only working at less than 15% of its max capacity. The market for luxury EVs is simply too small to absorb their massive fixed cost.
We ride at dawn. No, we're up long before that, putting in the work, powered by Big's off. We don't just...
EVs is simply too small to absorb their massive fixed costs. In the first quarter of 2025, Lucid burned $590 million. They have $4.5 billion of cash and equivalents on their balance sheet. At the current rate of cash burn, this will be gone in less than 2 years. They also have $2 billion of loans coming due in December of 2026. Going into 2025, the situation of Lucid Motors looked very dire indeed. While their EVs have received critical acclaim, the company is burning cash at an unsustainable pace. The rate of deliveries needs to increase by an order of magnitude before they can have any hope of reaching profitability. On July 17th, Lucid announced a new partnership with Uber. Uber will make a $300 million equity investment and purchase 20,000 Gravity SUVs over the next 6 years. They will use these Gravities to launch a robotaxi service. This is actually a three-way partnership between Lucid, Uber, and another company called Nuro. Nuro was founded in 2015 by former Waymo engineers. They develop autonomous vehicle technology, making use of LiDAR and other sensors. At first, they focused not on building a robotaxi, but instead an autonomous delivery vehicle. They developed a custom autonomous vehicle that is not capable of carrying passengers. It has no seats, and the inside is occupied by a large cargo compartment. In 2022, Nuro signed a partnership with Uber's food delivery service, Uber Eats. Currently, Nuro delivery vehicles are operating in a few select areas in Mountain View, California, and Houston, Texas. If you live in these locations and make an order on Uber Eats, a Nuro autonomous vehicle may deliver your food. The vehicle will park on the street in front of your house. When you walk up to the vehicle, a door will open so you can pick up your order from inside the cargo compartment. Uber's ride-hailing business is set to face an increasingly competitive threat from Google-owned Waymo. Currently, Waymo provides more than 250,000 paid trips per week in Phoenix, San Francisco, Los Angeles, and Austin. Waymo is planning to rapidly expand to more cities over the coming years. If the future of ride-hailing is autonomous, it is imperative for Uber to make its own robotaxi service if it wants to survive. Lucid will create a new production line at its Arizona factory that will integrate the various sensors and other self-driving hardware supplied by Nuro. The vehicles will be purchased by Uber, which will use them to launch a robotaxi service in 2026. There are likely two main reasons Uber chose the Lucid Gravity. It's a spacious vehicle which can be configured to hold up to 7 passengers. Secondly, its long range of 450 miles means it can operate many rides before it needs to be recharged. Remember that Lucid is majority owned by Saudi Arabia's sovereign wealth fund. Interestingly, the Saudi sovereign wealth fund is also a major shareholder in Uber. They made a $3.5 billion investment in Uber back in 2016. As a result of this investment, they obtained a seat on Uber's board of directors. Could the Saudis have influenced Uber to partner with Lucid? Perhaps, but we also shouldn't overstate their influence over Uber. They only have 1 board seat out of 11 and only own 3.5% of Uber's outstanding shares. On the merits, the Gravity does appear to be a good option for a robotaxi. The main downside is its high cost. The Gravity Grand Touring costs $95,000. Later this year, the cheaper Touring trim will be released, which costs $80,000. Presumably, Uber will purchase the cheaper Touring trim. So how much revenue can a robotaxi generate, and how long will it take to make back this investment? According to the price comparison app Obi, the average cost of a Waymo ride is $20.43. Interestingly, this is significantly more expensive than Uber and Lyft rides in the same areas. Perhaps people are willing to pay a little bit extra for the novelty of riding in a robotaxi. As of May of 2025, Waymo claims to have 1,500 vehicles on the road, which conduct 250,000 paid rides per week. That means each Waymo conducts 167 rides per week, or 24 per day. Therefore, each Waymo is making almost $490 per day, or $180,000 per year. In theory, the Gravity robotaxi should be able to make even more money than Waymo. Waymo uses a Jaguar I-Pace, which can seat 5 passengers and has a range of 250 miles. The Gravity can seat 7 passengers and has 450 miles of range. Longer range means less frequent charging stops and thus more time on the road. Given the high revenue potential of the robotaxi business model, it's conceivable that Uber could make back the $80,000 purchase price of each Gravity pretty quickly. With all that being said, we don't know how safe or reliable the Uber robotaxi will be. Nuro has been operating autonomous food delivery vehicles for a number of years now, but these are geofenced in a very small area. An effective robotaxi service will need to operate over much larger areas, which is far more difficult. In the most recent quarter, Lucid delivered 3,109 cars to customers. Assuming they maintain the same pace, they'll deliver approximately 12,500 vehicles in 2025. Uber is going to order 20,000 Gravity SUVs over the course of 6 years, or 3,333 per year. If we add those two numbers together, Lucid will be delivering a little less than 16,000 cars per year. Remember that their factory has a production capacity of 90,000 cars per year, so they'll still only be at 18% capacity utilization. While the Uber partnership is certainly a positive, it's far from a game changer. If Lucid wants to achieve economies of scale, they need a more affordable vehicle. They are currently working on a new mid-sized EV platform, which will include a sedan and a crossover, both with starting prices around $50,000. We have almost no details about these new, cheaper models. Lucid says it intends to release them in late 2026, with production ramping up in 2027. In the meantime, the company is losing an obscene amount of money. Over the past 12 months, Lucid burned almost $3 billion. They currently have $4.5 billion of cash and equivalents. The $300 million investment from Uber will bring that up to $4.8 billion. This will only last them less than 2 years. Realistically, the only way Lucid can survive is if Saudi Arabia continues to bail them out. The Saudis have already pumped $8 billion into the company. How much more money are they willing to lose? This is anybody's guess. Alright guys, that wraps it up for this video. What do you think about Lucid Motors? Let us know in the comments section.
Can't do drip. Diamonds on my wrist, they dripping.
This might be my greatest creation ever made. It's called the Terminator Cold Loom System, and it's one of...
Yakuthanda kodwa ngisho ngibiza ngenja kodwa lenja iyakuthanda.
Hey banna
usho kanjani lokho?
Where you from?
No, thank you. I actually take that as a compliment. Born, raised, educated.
Soweto,
period. Like I only moved out of home after AAA. Why are you looking at me like
where was home?
Pimville.
Born there,
raised there.
What were you visiting?
Born
Northwest.
No, I get about Holo, about tobacco wrestling leg. So maybe that's where I.
Yes. Okay. So you maintained Huitis Tswana through your parents or grandparents?
It was a conscious decision.
From them?
For myself. If that makes sense. No, so interesting thing.
Look,
like
Penson on here.
No, I can hear you guys. I can hear you guys. I can hear you guys. Speak your language. There are 12 official languages in this country. Yeah, English and. Yeah. No. I know. I'm very learned. Did you taught yourself? Now I taught myself. No. But honestly, like I didn't really teach myself. Like it was a mix of Tswana and English. In Pimville? Yeah, I mean like most kids. When I go to
Tembisa.
When I go to
Tswana.
Same thing.
Let's go. When you're in Tembisa, I'm very dependent. Tembisa, I think Tembisa is after Limpopo. In Tembisa and Pitorum, there's a lot of Pedi people there. Yeah.
Now I grew up around my Pedi.
Where did you grow up around Pedi people?
In Matati. And the big people in Matati. Hey, okay, you guys come close. No, I got you. You guys are. No, retla support. In request. Yeah, Kalibu.
I thank him,
Yes, sir.
What did you want to talk about?
So let me just leave. No offenses. So thank you so much for coming through, brother. We truly appreciate you. Sure. So down in my chance, we're just chilling, cooking in the kitchen. There's no script, there's no guide, it's not an interview. It's just organic chats. We just, if you want to talk about cell phones, we talk about cell phones. We just, again, have the cameras in front of us. The idea was just around, is there a space where Machita can just be a Machita? Yeah. You know, talk as a Machita, be free. If you want to talk rubbish, talk rubbish, talk sports, you know, and let's just record that and just upload it for the main side.
I'm not into sports, you know, so it's sad. I'm not into like typical.
What's the sport of sports?
Yeah, I mean, you're Formula One, so it's tennis, Formula One.
E-sport is Abantu Baba.
In tennis?
Abba? No, finish. How? The F1, the tennis. So when you just sport of stars, you want to sport la, sport la, Caitlyn Jenner so.
I don't know, man. And at home they love soccer.
Sure.
They love soccer.
Do you know?
Yeah.
I think the older I get, the more desensitized that I get to sports. Like I can't tell you 5 players but than Chiefs right now.
And you were obsessed with soccer before?
I was proper obsessed. I mean, I was actually obsessed with Chelsea.
Sure.
But I think the older I got, the more I was like, the opportunity cost. I getting excited. Step back because it's not as powerful. It was an emotional investment for me, and I didn't like the fact that other men. Yeah. In a different country or in a different can make me feel this way. Yeah. That's it. Yeah. Other men. Yeah, that's when it. When they lose, they're making money. Yeah. When I'm not yeah. Other men can ruin my day. Yeah. Or my week or my whatever. Other men, bro. Yeah.
And TV, fun.
The other men, I've seen guys cry because of other men.
Be upset.
I don't know if my dad cried. I remember what Tembisa, I can remember there was a Tembisa Classic.
Yes.
I think it was in the PSL.
Yes, it was in the PSL.
Yeah. My dad was obsessed. When it loses, that whole house is a mess.
No one is talking to anyone. No one is. I was that guy.
Yeah.
I was. When it comes to rugby, no one must speak to me. No one must. My team lost as if I had an effect on the game.
Like you should hold that guy.
Bro.
Yeah.
Nothing. Whether it went nothing. If we were planning to go out for drinks, I'm sad.
Because you're sad.
I'm sad.
No, I understand because I also felt like that.
Nah, dog. Once I realized the emotional investment is just too much, I took a step back. We went to go watch stuff for the UEFA finals this weekend. Great experience, phenomenal experience.
I saw you on the Heineken bus.
Oh wait, don't worry about me. Don't worry about me.
Hey,
don't worry about me.
Tell me about that experience. How was it?
Nah, bro, I'm used to these things.
When?
I'm a big deal.
My fingers on. When
I'm
friends
sometimes it's just you that doesn't know a person.
Okay.
By the time Upeli Makanti got signed, in FC Port, people were like, oh, who's this guy?
Yeah.
They didn't know the person. We did.
From Cape Town Spurs. Was it Cape Town Spurs?
Wherever he was. But I'm saying,
yeah.
There's people that don't know you, and then there's people that know.
So you.
If you want to do any type of mining, there are 3 key aspects to consider. First, you need to secure rights to mine in a particular area. This usually means either owning the land or obtaining a license or lease from the government or landowner. Once you have the rights, the next step is extraction, physically removing the mineral-bearing material from the ground. Finally, you must process the ore, since most minerals, like copper for example, aren't found in pure form. Instead, they occur in ores mixed with other metals and rock, which must be separated to produce a usable product. These 3 stages come with 3 main costs: the cost of securing mining rights, the cost of extraction, and the cost of processing. To be profitable, the total cost must be lower than the market price of the commodity. Historically, all metals mining has happened on land. There are only limited deposits of valuable metals on land. The deposits that are easiest to mine are exploited first. So over time, you need to move on to more and more difficult deposits that are more costly to extract. Land-based mining also comes with environmental consequences, such as the need to chop down forests to mine the metals underneath. As the global electricity grid turns to renewable energy, demand for many metals is expected to increase. For example, a large offshore wind turbine can contain up to 30 metric tons of copper. Electric vehicle batteries can require large amounts of nickel, cobalt, and manganese. As demand for these metals increase, many fear that it may not be possible to supply sufficient quantities from land-based mines, at least not at an acceptable economic or environmental cost. So in recent decades, attention has turned to oceans, which have vast metal resources that have yet to be exploited. Scientific research conducted in the late 1970s has identified large quantities of cobalt, nickel, manganese, copper, and other valuable metals on the ocean floor. The metals on the sea floor are worth hundreds of billions of dollars at current market prices, but exploiting these valuable resources will be an endeavor of daunting cost and complexity. Remember the 3 main costs of mining: securing the license, extracting the ores, and processing the ores into usable commodities. Deep sea mining poses unique challenges in all 3 aspects. First, let's talk about the licensing. Every nation that borders the ocean has an exclusive economic zone extending 200 nautical miles, or 370 kilometers from their shores. Any nation is free to grant deep-sea mining rights within their exclusive economic zone. Deep-sea mining in international waters is regulated by the International Seabed Authority, which is part of the United Nations. We'll discuss them in detail later. Once you secure a license, the technical challenges are immense. You need to send a remote-controlled rover to the bottom of the ocean. It needs to pick up the metal-containing ores and separate them from the dirt and other debris on the ocean floor. You then need to pump them thousands of meters up to a boat on the surface of the ocean. The first serious attempt at deep-sea mining was made by Nautilus Minerals. Nautilus was founded in Canada in 1997 by an Australian-born geologist named David Haydon. In 2001, Haydon's friend, Gerard Barron, invested $226,000 into the venture. Barron made his fortune by founding an advertising company in Australia. In 2007, Nautilus listed its shares on the Toronto Stock Exchange via reverse merger. A reverse merger is an alternative to a traditional IPO, whereby a private company acquires a defunct penny stock company so as to gain its stock exchange listing. By the end of 2007, Nautilus had raised approximately $300 million. By this point, the company had already secured mining permits within the exclusive economic zones of Fiji, Tonga, the Solomon Islands, New Zealand, and Papua New Guinea. Of these licenses, the most promising was the so-called Solwara 1 area off the coast of Papua New Guinea. Initial exploration activities had already identified high-grade copper and gold deposits at a depth of 1.7 kilometers. The original plan was for Nautilus to begin mining in 2009, just 2 years after going public. This timeline proved to be widely optimistic. Commercial deep-sea mining has never been done before. Specialized equipment needs to be designed and built from scratch. Nautilus hired a UK-based company called Soil Machine Dynamics to build a massive underwater rover with a crushing device to crush rocks into small enough pieces to pump them up to the surface. They hired a Belgian company called Jan de Nul, which specializes in building dredging ships. They needed a custom ship that could deploy massive hydraulic pumps to pump up the minerals almost 2 kilometers from the ocean floor. The ship was supposed to be delivered in 2009, but in 2007, for reasons that are not entirely clear, the order was cancelled. So they instead signed a contract with a Singaporean company called Seatech Solutions, which would build a specialized ship for Nautilus at a shipyard in China.
Looking to hire? ZipRecruiter delivers candidates with the right skills and experience fast. So fast.
China. In 2008, David Haydon stepped down as CEO of Nautilus. He said the company needed new leadership. Why he thought he was no longer capable of leading the company is unclear. After Haydon stepped down, Nautilus was briefly led by a man named Stephen Rogers, who I was not able to find any pictures of. In 2012, Rogers was replaced by an experienced mining executive named Mike Johnson. Despite the engineering delays, there are some reasons to be optimistic. Nautilus had the full support of the Papua New Guinea, or PNG, government. Starting in 2011, the PNG made a series of investments into Nautilus, ultimately totaling $120 million US. This was in exchange for 15% of the profits generated by the Solwara 1 mining projects. In addition, PNG would receive a percentage of the revenue as royalties under the terms of the mineral extraction license. PNG is a relatively small and poor country. At the time, their entire government budget was only about $3.5 billion, so a $120 million investment into Nautilus was huge. So let's look at the details of the Solwara 1 project. There's an underwater volcano. The area around the volcano is rich in copper and gold ores. The undersea rover is connected via a giant 1.7 kilometer long tube that goes onto a surface vessel. A slurry containing water, dirt, and ores are pumped up the 1.7 kilometer tube. It's certainly possible to extract resources from the ocean floor. For example, offshore oil rigs have been used for decades, and the deepest ones reach down more than 2 kilometers. But there are a few key differences between drilling for oil and mining for metals. Firstly, oil is a liquid, making it far easier to pump. Secondly, the oil deposits are in a fixed location, so you can build a massive stationary oil rig to house all the large and heavy equipment. In the case of deep-sea mining, the metal ores are spread out sparsely on the surface of the ocean floor over a wide area. Thus, the undersea rover and surface vessel need to be mobile. The metal ores are very heavy, requiring massive hydraulic pumps to lift up to the surface, and you only have limited space on the support vessel to house the pumps and all the other necessary equipment. This is a very difficult engineering challenge. By 2018, the Chinese shipyard was still working on Nautilus's customized surface vessel. Nautilus did not pay for it up front. Instead, they were required to make installment payments over the course of the construction. In 2018, Nautilus ran out of money and defaulted on these installment payments. In 2019, Nautilus declared bankruptcy and ceased operations before mining a single ounce of minerals. When the company first went public, they estimated they would need $120 to $150 million US of capital expenditures to begin mining. By the time they went bankrupt, they had cumulatively raised and burned through $686 million, or approximately 5 times their original cost estimate. By the end, they had procured the undersea rover and hydraulic pump system, but we don't know if these would have even worked in practice. They were never tested because they did not have the customized surface vessel. When Nautilus declared bankruptcy in 2019, its shareholders suffered a total loss on their investment. But one person who profited handsomely was Gerard Barron. Back in 2001, he invested $226,000 to buy a significant stake in the company. Shortly after Nautilus went public in 2007, he sold all of his shares for $31 million, backing a gain of more than 100 times. He would later tell Bloomberg News, quote, "I originally invested in Nautilus not because I knew mining, but because I just sort of thought it sounded cool, and I sold out at the right time," unquote. Remember that David Hayden, the founder of Nautilus Minerals, stepped down as CEO in 2008, just 1 year after the company went public. In 2011, he founded a new company called Deep Green Resources. He hired Gerard Barron to help them talk to investors and raise capital. Deep Green aimed to mine metals from the bottom of the ocean. He started selling his shares in Nautilus to fund Deep Green. Perhaps by the early 2010s, it had become obvious to Hayden that Nautilus would be a failure. But if so, why would he expect his second deep-sea mining startup to be any more successful? Deep Green plans to mine the Clarion-Clipperton Zone, or CCZ. The CCZ is located in the middle of the Pacific Ocean. It is in international waters, far outside the exclusive economic zone of any country. This means it is regulated by the International Seabed Authority, or ISA. The CCZ has large quantities of polymetallic nodules, which contain metals including copper, nickel, cobalt, and manganese. The seabed in the CCZ is approximately 4 kilometers beneath the surface of the ocean. This is significantly deeper than the Solwara 1 deposits that Nautilus failed to mine. In 2017, Barron was appointed as CEO of Deep Green Resources. Barron has no formal training in geology. His main skills are in advertising and fundraising. In 2019, Gerard Barron attended a mining conference in South Africa, where he tried to raise funds for the company. While he was there, he gave a short interview where he talked about Deep Green's prospects.
As we start to move down the pre-feasibility, as we are now, and into feasibility, what we're going to find is that the challenges aren't as great as people might have imagined. Because back in the 1970s, they started to collect these metals from the ocean floor. It was only the regulations that stopped them. And so the regulations are now much more secure. We have exploration licenses. By the middle of next year, we are confident that we'll have exploitation licenses. So that gives us a legal framework under which to operate. And so then it's just about solving some of those other little issues, like lifting them up 4,000 meters. But engineers love solving a problem, and of course we're engaging industry.
So according to Barron, the technical challenges of deep-sea mining aren't that difficult. The only reason it hasn't been done is because there is no way to get regulatory approval. However, this is a gross misrepresentation. He gave this interview in 2019, the same year that Nautilus Minerals declared bankruptcy after burning through almost $700 million of cash. Nautilus was operating within the territorial waters of Papua New Guinea. They only needed to get a license from the government of Papua New Guinea, which they did. The reason Nautilus failed is because of the extreme technical challenges of extracting minerals almost 2 kilometers beneath the ocean's surface. The International Seabed Authority is an intergovernmental body founded in 1994 and headquartered in Jamaica. It has 167 member states plus the European Union. Companies that want to conduct deep-sea mining in international waters need to be sponsored by the government of an ISA member state. If and when a company ever receives a license to mine in international waters, they'll have to pay royalties to the ISA. The ISA will distribute the royalties amongst its member states. The idea is that international waters are a common resource. Thus, the economic value of deep-sea mining should be distributed to all countries in an equitable manner. In 2011, Deep Green created a subsidiary called Nauru Ocean Resources Inc., or NORI. NORI is domiciled in the tiny island nation of Nauru. Through this subsidiary, they are able to be sponsored by Nauru, which is a member nation of the ISA. In exchange for the sponsorship, Deep Green agreed to pay royalties to the Nauru government once they begin mining in the CCZ. This is in addition to the royalties they will have to pay to the ISA. With the help of Nauru, Deep Green obtained a 15-year exploration license for an area within the CCZ, spanning approximately 75,000 square kilometers. However, this only allowed Deep Green to conduct tests and create environmental impact reports. They are not yet allowed to commercially extract any nodules. In 2021, Deep Green changed its name to the Metals Company and went public on the Nasdaq by merging with a SPAC. The SPAC transaction valued the company at $3 billion. In their SPAC presentation, the Metals Company, or TMC, estimated that its project sponsored by Nauru had a net present value of $6.8 billion. They estimate the deposit has 356 million tons of metals, mostly manganese, copper, and nickel. Based on current stock prices, these would be worth $95 billion. On this $95 billion of revenue, TMC expects to generate $57 billion of EBITDA. EBITDA is earnings before interest, taxes, depreciation,